Babcock International fell 7.19% on Monday to 961.6p, the sharpest single-day drop in the FTSE 100. On the same day, it reported a 19% rise in underlying operating profit to £433 million. Revenue grew 10% at constant currency to £5.18 billion. Free cash flow jumped 71% to £262 million, 22% ahead of analyst forecasts, according to Jefferies. The board completed a £200 million share buyback and immediately launched another £200 million program. The full-year dividend rose 15% to 7.5 pence per share. On every metric the market tends to reward, Babcock delivered, and the market sold. The explanation sits in the one number that fell, a £140 million charge on the Type 31 frigate program, which cut statutory operating profit 16% to £305 million. Jefferies noted the charge was larger than many investors had expected, even though Babcock had signaled the program's difficulties in prior years. That gap, between a beat on underlying performance and a miss on the charge's scale, split the investor base in real time. Peel Hunt maintained a buy recommendation with a 1,409 pence target, citing the cash generation and a 25% discount to a peer basket of defense and civil engineering companies. Other investors trimmed positions on the absence of a guidance upgrade, concluding that without a positive revision, there was no near-term catalyst to push the shares higher. The same set of results, the same morning, produced opposing actions, and the bottleneck that explains both is not the charge itself, but what the charge reveals about the contract structure that produced it. The Type 31 frigate contract was placed in 2019 with Babcock's Rosyth yard and represents less than 4% of group revenue. In the 5 years since, Brexit raised supply chain costs, COVID disrupted labor supply, raw material prices surged, and UK wage inflation ran well above the contract's base assumptions. Babcock's own statement acknowledged that the contract offered only certain escalation clauses, limited protection against cost increases relating to Brexit, COVID, raw material prices, and UK labor shortages. The total charge now stands at approximately £330 million across the FY23, FY24, and FY26 financial years. The buried assumption the defense re-rating thesis requires is that this is a legacy contract anomaly, written before the inflationary era, and not a sign of how the UK government structures procurement more broadly. Two separate sources in the pool draw opposing conclusions from that assumption. Investors Chronicle concluded the setback fails to sink the investment case because ships 3 through 5 remain at earlier build stages, and the incremental impact will be comparatively reduced. Jefferies took the other view, that the charge's scale indicated the market had underestimated how much residual risk remained, even after 2 prior provisions. The market's question is not whether the 5 frigates get built. The question is whether a company whose margin improvement to 8.2% required stripping out a contract it cannot make profitable is actually on track for the medium-term 9% target, or whether the headline margin is structurally dependent on the absence of similar fixed-price exposure elsewhere. That dependency is the variable no analyst can resolve from the current disclosure. What an investor watching Babcock's margin trajectory is really tracking is not the existing Type 31 remainder. It is whether the next large domestic shipbuilding or engineering contract is written with adequate protection or under the same government procurement template. Babcock's nuclear division is the counterweight to the frigate overhang. Nuclear profit rose 23% and margins reached 9.5% in FY26, ahead of the group's medium-term 9% target already, and in a division expected to maintain double-digit revenue growth. The group manages all in-service support for the UK's nuclear submarine fleet and holds a £9.8 billion backlog, equivalent to approximately 2 times last year's revenue. Babcock has also expanded internationally. Indonesia signed a £4 billion maritime partnership program in FY26, with a letter of intent for 2 additional Arrowhead 140 frigates, joining 2 already under construction. The U.S. partnership with HII, the largest military shipbuilder in America, was extended to cover Virginia-class nuclear submarine components, a program with no ceiling in sight, given the U.S. Navy's multi-decade build schedule. This is the evidence for Peel Hunt's £1,409 target and its mid to high teens earnings growth forecast over the medium term. The unresolved variable, however, is not the commercial performance, it is the UK government customer. On 22 June, the same day Babcock published its results, Keir Starmer announced his resignation as Prime Minister. John Healey had already resigned as Defence Secretary after the long-delayed Defence Investment Plan was found to offer only £13.5 billion, far short of the £28 billion over 4 years that officials argued was needed. NATO Secretary-General Mark Rutte is pressing the UK on a credible path to spending 3.5% of GDP on defence by 2035. The UK is currently tracking at 2.68% on core defence. Babcock's results note this directly. While some governments are balancing these priorities against fiscal constraints, as reflected in the delayed publication of the UK's Defence Investment Plan, the long-term trend remains clear. The nuclear growth thesis rests on that long-term trend. But the FMSP, the Fleet Marine Ship Programme, Babcock's multi-billion-pound submarine support contract, requires renewal, and that renewal requires pan-Whitehall funding approval and political sign-off. Deputy CEO Harry Holt said the renewal work is substantially complete, but that funding certainty and pan-Whitehall approval have yet to arrive. Babcock's 70% revenue visibility for FY27 is real, but it includes contracts that require a functioning, funded, committed UK government to renew. The bull case requires that a Burnham-led Labour government closes the dip gap and signs the FMSP. The bear case is that fiscal constraints and a leadership transition delay that approval, compressing the backlog faster than new wins replace it.
The counter-evidence to the bull case is in the pool and warrants a direct confrontation before any conclusion. Babcock's own guidance acknowledges the FMSP uncertainty. The delay is seen as a delay in opportunity rather than a threat. Management language that concedes the renewal is not in hand. That is not a trivial risk for a business where the nuclear division accounts for nearly 40% of revenue and is the primary driver of margin expansion. The position that survives this confrontation is a conditional one, not a directional verdict. Peel Hunt's 1,409p buy rating and the market's 961.60p net selling price are not both right. But the variable that resolves which is correct is not Babcock's operational performance, which has already demonstrated itself. It is the FMSP contract renewal timeline and the UK Defence Investment Plan publication, now in the hands of a government that has not yet taken office. The verification trigger is not the next quarterly result. It is the earlier, leading signal, the UK's DIP publication, which outgoing Prime Minister Starmer committed to delivering ahead of the NATO Ankara summit on 7 July, a commitment now passed to his successor. If the DIP is published with credible multi-year nuclear and maritime commitments, and FMSP renewal proceeds to formal contract, the Peel Hunt case for 46% upside is grounded in operating performance that already exists. If the DIP is delayed or reduced under a new leadership transition, and the FMSP renewal slips beyond the FY27 window, the market's negative 7.19% reaction was not a mismatch. It was pricing forward. For a holder, the action criterion is FMSP formal contract sign-off and DIP publication, not the next earnings release. For a watcher, entry is justified only after those two government decisions remove the pipeline dependency, not before. The underlying business, $262 million in free cash flow, 8.2% margin, 19% profit growth, is not in question. The question is whether the government that funds 70% of its visible revenue will honor that visibility on schedule. If the DIP arrives ahead of the NATO summit with commitment intact, the Type 31 charge was the last legacy overhang and the re-rating resumes. If it does not, the charge was a signal about the contract structure, not an accident. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.